Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And this week, a roadmap to what Warren Buffett and the tech giants are buying, because we're digging into the recent 13F filings to get an inside look into how the rich are getting richer. One of these stocks I uncovered in April is already up 111%, and now 3 new names just popped up in these filings. Stick around and I'll also update our stock market outlook and give you important updates to shares of SoundHound AI and Palo Alto Networks. But first, a huge announcement. I'm going to be speaking at the Blossom Investor Tour in New York and Chicago in October and having our first ever Let's Talk Money meetups. The Blossom event is going to be at the NASDAQ market site on the 3rd and then in Chicago at the CBOE on the 7th, but I'll update you over the next few weeks where the Bowtie Nation is going to meet up earlier in that day. Until then, look for the special invite link in the description and join me on the Blossom Investing app. I just started using it a couple of years ago and love the app for getting ideas and sharing my own portfolio. You can connect your brokerage accounts or just input your portfolio to track all your stocks in one place. You're going to see insights like portfolio percentages and average dividend yield across the entire group. You'll also be able to join more than 400,000 investors in the social feed to see what everyone else is talking about. I've shared my portfolio on the app. It's totally free to download, so look for the link I'll leave in the description and check that out. Back to our main topic though, and Warren Buffett revealed his stock picks last week with the Berkshire Hathaway 13F filing, showing which stocks the company bought and sold from its portfolio in the second quarter of this year. And for a guy that says diversification is only for those who don't know what they're doing, this thing is a beast with more than 30 stocks. Now, the big news was the addition of 5 million shares of United Health Group, ticker UNH, for $1.6 billion, which sent the stock up more than 12% on Friday. Buffett also opened up new positions in Allegiant, ticker ALLE, homebuilder D.R. Horton, DHI, Lamar Advertising, LAMR, and steelmaker Nucor, NUE. While not new positions, he added shares of Chevron, ticker CVX, Coca-Cola, ticker KO, and American Express, AXP, during the quarter. Buffett's only total sellout this quarter was of shares of T-Mobile, ticker TMUS, which I can understand because their coverage sucks. But he also sold nearly half of his stake in Charter Communications, CHTR, cutting another 20 million shares of Apple, AAPL, and then 26 million shares from his Bank of America holdings, BAC. All in all, it was an active quarter for Buffett, who's had trouble adding stocks over the last few years and is now sitting on over $340 billion in cash. He went heavy into homebuilders with D.R. Horton and Lennar while continuing to cut shares of bank stocks. Now, some of these I'm not so sure about, like cutting Charter Communications, which I pointed out last week could have a 39% boost to cash flow coming from the BBB tax changes. It is already about 50% discount to its price to cash flow valuation. Nation, this was all from the company's 13F reports. Those are mandatory filings by the Securities and Exchange Commission, the SEC, that is the closest thing to insider information you can get without the handcuffs that go with it. While Buffett's stock buys always fill the news, it's 2 other 13F reports from the biggest tech companies that caught my eye. The reports by Amazon and Alphabet, with a combined $4.5 billion invested and some big changes. Now, you can always find these 13F filings by going to the SEC Edgar database online and searching for the company name, then click through to where you see the most recent 13F reports from that list of investments. Now, there are a few different reasons why a company might buy shares in another, one for a stake in a key supplier or ahead of a future acquisition. There's also just good old return motivation. So while these reports and the stocks aren't a green light to buy, it always puts them on my list for more research. Amazon reported 1 new position and sold out of 2 others, but left most of its stocks unchanged last quarter. The most surprising here was a new $116 million position in Advanced Micro Devices, ticker AMD. Now, we've been buying AMD since February and went all in on that April sell-off at $85 a share. Now, of course, NVIDIA still rules in AI chips, but with hundreds of billions in spending from big tech, AMD is getting a big share of that too and is up over 111% from that April low. Amazon sold completely out of its shares of Twilio, ticker TWLO, and cut 1 million shares from its holding of quantum company IonQ, ticker IONQ. Shares of Twilio plunged 30% on that news in early August, while IonQ barely budged, though we're already flat for the year. Now, I still like IonQ as a leader in the quantum race, but it's a very long-term pick and going to be a roller coaster along the way. For its part, Google parent Alphabet, ticker GOOG, has a massive portfolio worth over $2 billion, most of it in biotech and life sciences companies. It bought 3 new stocks last quarter, AST Space Mobile, ticker ASTS, which was already up more than 100% from June, so the news really didn't affect the stock much, as if it had already leaked out from insiders, as well as new positions in Maze Therapeutics, ticker MAZE, and Metsera, MTSR, both biotech companies. Now, one warning with following Alphabet into some of these stock picks is that a lot of this is in that biotech and life sciences, which are notoriously difficult to analyze. Now, I try to avoid them here on the channel because you really do need that deep industry experience into pharmaceuticals, lab testing, or medicine to be able to work through those drug trials and the FDA approval process. Without that knowledge, you're setting yourself up for 20 and 30% swings in a stock price when that testing news comes out, and it's not always in the direction you want. Beyond those few stocks, Alphabet mostly cut or sold out of positions last quarter. It sold shares of Lyell Immunopharma, Vera Therapeutics, and sold completely out of Benson Hill, Q Health, Desktop Metal, Kronos Bio, Rani Therapeutics, and Invitae, which got delisted. And two sales were really interesting though, selling 3.3 million shares of GitLab, GTLB, down to 2.7 million share position, and selling all of its position in CrowdStrike Holdings, ticker CRWD. Alphabet has been progressively offloading its shares of GitLab, which just as recently as November, it owned 9.7 million shares for almost 6% of this company. While competition is rising in that code developer space, GitLab is one of the best platforms integrating AI into its process and is still expected to post 20% plus revenue growth this year and next. For that growth, shares are very attractive here at just 8 times price to sales, and even cheaper, 7 times valuation on this year's expected sales. More surprising though was Alphabet's complete sellout of its CrowdStrike holdings, though at $181 million, it's not a strategically large investment for the company, and with the shares up 319% over the last 5 years, maybe Alphabet just wanted to book some of those profits. You out there in the nation know CrowdStrike is my favorite stock and my favorite growth theme, cybersecurity, and in fact is my largest position in that theme, along with Zscaler, Fortinet, Palo Alto, and Okta. So I'm going to keep on holding here and adding as that theme grows over the next decade. Both CrowdStrike and IonQ also got votes of confidence from Brian over at Business with Brian last week in his top 10 forever stocks list. Brian pointed out IonQ's trapped ion architecture, a competitive advantage against other quantum stocks using superconducting qubits. He also likes that cybersecurity theme and pointed out the AI strength in CrowdStrike. Brian compared his list to one of my earlier videos, so I'm going to link to that in the description below. Check it out and let me know what you think. Now looking at the stocks I'm watching this week, SoundHound AI, ticker SOUN, is one everyone has been asking me to update after a blowout earnings, sent the shares up 40% in the past month, now up 268% since we started buying it in February of last year. And I'll admit that valuation of 49 times price to sales has me worried here. Now I did take some profits in January when it was coming down from that run to $25 a share and bought back in around the $8 low during the April sell-off, but I don't think you want to be jumping in and out of this because you're going to miss out on that meteoric growth that could be ahead. Now here, I want to play a clip from the CEO's interview on Bloomberg, and you're going to see what I mean here.
It was a blowout quarter. It was the strongest quarter on record for us. Revenue was up more than 3 times. And every business unit delivered success. We had strong growth in AI for automotive, strong growth for AI for enterprise, and strong growth for AI for and automation for restaurants.
In terms of your business and your technology, it powers conversational AI, and that's really what you've built your platform around. But you're also expanding to new industries. What's the thinking behind this effort to branch out? Why now?
Well, this is the time for us to do more. We spent 20 years with focus to build the best conversational AI platform in the world. We constantly compare our technology with others, including the big tech. We beat them in accuracy by over 35%. We beat them in latency by over 4 times. All of that running at a lower cost. Now we are expanding to new verticals. We started in automotive. We went to IoT. We went to restaurants, AI for restaurants. And then last year we went to enterprise. We power 7 of the top 10 financial institutions. We are in healthcare. We are in insurance. We also power smaller businesses. You can be a single location barbershop and have your own AI customer service in a matter of minutes.
The strongest quarter on record. That's saying something for a company that has grown its revenue by more than 500% in less than 4 years, and that momentum is not slowing down, now being able to cross-sell customers across segments. It was the comments on the expansions, though, that got me. This company is dominating the $160 billion voice AI market and moving into every aspect of it. That's going to make even the $166 million in this year's expected sales seem like a rounding error. I'm going to hold on here because even if 5 or 10% of that $160 billion market, which would mean upwards of $16 billion in annual revenue, nearly 100 times this year's sales, SoundHound is going to be the Amazon of voice AI, and I don't want to look back and say, why did I sell so early? I also wanted to look at Circle Internet Group, ticker CRCL, which is getting much more attractive, around 10 times sales valuation, but it's just hard pulling the trigger with all the near-term headwinds. First, we're seeing the company and insiders jump ship early, selling 10 million shares before the lockup period is over after that IPO. No, it's totally legal, but usually insiders wait for that 90-day lockup period to expire to take those profits, so getting out this early isn't going to help investor sentiment. Second here, even on the massive 90% circulation growth the company reported in its USDC coin when it reported earnings, taking that coin to $61 billion and stablecoins past $250 billion, this company is going to see its profitability weaken as it offers more yield to distributors like Coinbase, and there just isn't much to offer on the paltry 5% it earns on treasury bills it has to hold to stabilize the USDC. Now, part of that Genius Act that creates the stablecoin framework here forbids issuers like Circle from directly offering yields on their coins, so it has to pay off platforms to offer that yield to users by sharing its own profits. And third here, as the Fed cuts rates in September and beyond, we're going to see that yield that Circle earns on its treasury bills fall, which is going to further erode profits. I still do like the stablecoin theme, but Circle just needs to see that massive circulation growth just to keep growing its own earnings. And if that's the case, if we do see that new era of stablecoins, why not just invest as I've been doing with the Ethereum Mini Trust, the ticker ETH, up 77% since I started recommending it on June 30th. I would revisit Circle if it fell closer to $110 a share, about a $27 billion market cap. That would be about 8 times next year's forecasted revenue and make it more compelling on that growth story, but I can't recommend it just yet. Palo Alto Networks, ticker PANW, reports its earnings after the close on Monday and has me a little worried after Fortinet's disastrous earnings, a 23% crash when it reported. There are reasons to be optimistic, though, as Palo Alto really hasn't seen the big run that Fortinet saw, which was up 42% into its earnings. Now, expectations are also pretty modest here, with just 14% revenue growth forecasted, about the same as its full-year target, though if it warns on the enterprise customers and profitability like Fortinet, we could see a rough day on the stock. Management should be able to remain optimistic, though, as it talks up its announced CyberArk acquisition for $25 billion and brings some of that needed growth to the top line. The $1.6 billion in sales analysts had forecasted for CyberArk could lift Palo Alto revenue by a full 17%, in addition to the 13% growth already expected. That would bring back the growth investors and support these shares. The stock is already trading at a discount to these other cybersecurity stocks and to its own history, now at just under 14 times on that price-to-sales basis. That is 10% cheaper than the 15.5 times average valuation and would make it very cheap against next year's CyberArk-fueled growth. They're showing you that big picture here with the Sector Spiders sector tracker. 7 of the 11 stock sectors closed higher last week with no rhyme or reason to which groups outperformed. Some safety sectors like utilities fell, while others, healthcare and energy, did well. Growth sectors you would expect to do well in an up market, like technology, underperformed, while communication services was an area of strength. It's just further proof, folks, that this market right now is much less about the broad, big-picture economy and more about individual stocks. When one company in semiconductor space like NXP can jump 10% on its earnings on the week, while another like Applied Materials plunges 12%, you better know where each of your stock fits into its industry and how competitive it is. Now, it finally looks like the stocks in the healthcare sector are starting to get some of that love we've been waiting for, with 53 of the 60 stocks in the group higher last week and strong double-digit gains in a few. The insurers did especially well after Buffett's Berkshire Hathaway reported that stake in United Health, those shares up 21% on the week. Drug makers like Eli Lilly, LLY, and biotechs also outperformed. Now, medical device stocks did lag, with Medtronic and Boston Scientific barely finishing in the green, but could be buys from here. Now, updating our stock market outlook, there's relatively little in the way of earnings or economic data to support stocks this week, which could mean the market hangs on every tweet and drama. Now, that's not necessarily a good thing, with prices already at 28 times on a PE basis, close to that 2024 peak and 24% more expensive than the 10-year average price-to-earnings ratio. But nation, you never want to bet too hard against the market, especially one coming into new round of interest rate cuts and a president that wants to deregulate everything. But last week's Producer Price Index, that PPI measure of inflation, should have been a wake-up call. Month-over-month prices for wholesalers jumped the most in 3 years, 3.3% higher over the last year. And while some of that was broker profits that are going to be reversed out in the next month, combined with that tragically bad jobs picture that we got last month, where data was revised to show just 106,000 jobs created over 3 months, far below stall speed for the economy. I can't help feel like this is what we're going to be looking back on in a year from now, after we've got a damn near a recession and stocks have sold off, and say, well, yeah, it should have been obvious with those numbers, in that there are some stocks and sectors that should hold up well with already good valuations. Looking at a chart from FactSet on current PE ratios versus average valuations over the last decade, we see stocks in healthcare and energy both trading at discounts. These are the only sectors not trading way over their long-term valuations, so it's here where I'd be looking to stay invested but still have some safety from any market sell-off. Because when the bottom drops out of tech, priced at 30 times forward earnings for stocks in that sector, and and 36% premium to its long-term average. That drop is going to be fast. And that's something the analysts are watching as well, with energy and healthcare the two best sectors to target prices for stocks in those groups. From the current prices, stocks in healthcare have a 20% upside to their targets, while in energy it's 18% to those price targets. In healthcare, that means names like United Health Group and Humana, Eli Lilly, and Medtronic. In energy stocks, I like Devon Energy, Baker Hughes, Chevron, and Kinder Morgan. Join me on the Blossom Investing app with a special invite link in the description and see what's in my portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.